Hi everyone, welcome back to Property Investor TV. Today, we're going to tackle one of the most critical aspects of property investing, tax planning. Specifically, we'll be exploring the differences between using a limited company and operating under your personal name for buy-to-let investments. So, let's dive in. 0:30s pause for emphasis. First, let's define what these two options entail. When you operate as an individual, all rental income and expenses are reported on your self-assessment tax return. This means that any profits made from the investment will be subject to income tax at your marginal rate. On the other hand, using a limited company provides a level of separation between your personal and business affairs. As a company director, you'll need to file corporation tax returns, but the profits will remain within the company, allowing for more flexible tax planning opportunities. 1:00s pause. Now, let's look at some real-world examples to illustrate these points. Imagine you've got a £500,000 buy-to-let property generating £25,000 in annual rental income. If you operate as an individual, you'd need to declare this income on your self-assessment return and pay tax on it at your marginal rate. Let's assume that's 20% for simplicity. This would result in a tax liability of £5,000, 20% of £25,000. 1:30s pause. However, if you were to use a limited company instead, the story changes entirely. As a company director, you'd need to pay corporation tax on the company's profits at a rate of 19%. Let's assume your net profit from the property is £15,000. This would result in a corporation tax liability of £2,850, 19% of £15,000. 2:00s pause. Now, let's factor in some other considerations that might affect your decision-making process. For instance, as an individual, you'd have more flexibility when it comes to claiming expenses against rental income. This could lead to a reduced taxable profit and lower tax liability. On the other hand, using a limited company provides greater security for your personal assets, as the company's debts and liabilities are separate from your own. 2:30s pause. So, what's the takeaway here? The choice between operating as an individual or using a limited company for buy-to-let investments ultimately depends on your unique circumstances, investment goals, and risk tolerance. While there may be some advantages to each approach, it's essential to consider the tax implications carefully before making a decision. 3:00s pause. Thanks for watching, everyone. Remember to like, comment, and subscribe for more property investing insights and strategies. And don't forget to hit that notification bell so you can stay up to date on our latest content. See you in the next video.